Ladies and gentlemen, good day and welcome to Ratnamani Metals and Tubes Limited Q4 FY22 earnings conference call hosted by Monarch Networth Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sangui from Monarch Networth Capital. Thank you, and over to you, sir.
Thank you, Lizanne. Good afternoon to all. On behalf of Monarch Networth Capital, we welcome you all to the Ratnamani Q4 and FY22 earnings call. We are delighted to host the management of Ratnamani today, and from their side, we have Mr. Manoj Sanghvi sir, who heads the carbon steel division, and also their CFO, Mr. Vimal Katta sir. So without taking any much time, I'll hand over the call to Mr. Manoj Sanghvi sir for their opening remarks. Thank you, and over to you, sir.
Yeah, good afternoon to all the participants. So I welcome you to this call and hope everyone is doing good. Our results explaining the performance has been uploaded on our website, and I hope many of you have had a chance to go through it. I would first like to give you a brief on the numbers, and then we can take questions. Now, while narrating the numbers, it gives me an immense sense of satisfaction to inform you that FY21-22 has been the year of unprecedented revenue and profits, where the company has delivered highest ever annual revenue and profits in its 38 years of history. Our revenues have increased 40% year on year and 5% on sequential basis. For the full year FY22, it has increased by 36.6% as compared to FY21. EBITDA has increased to 178.4 crores from 141.3 crores on sequential basis, registering a growth of 26% on year-on-year basis. Albeit our EBITDA margin has slightly contracted on full year basis by 200 basis points. But in this quarter, due to picking up volume of SS products, the EBITDA margins have improved to 18% from 15% on sequential basis. Net profit margins have improved in this quarter to 11.3% from 9.5%. And for the full year basis, we have seen contraction of around 160 basis points, mainly due to inflationary pressure witnessed in the operating ecosystem. Company's cash profit has increased to 402 crores from 332 crores on the full year basis. And quarterly increase is by 25% sequentially and 8% on year-on-year basis. Our earlier capex has picked up well, and last year all products have performed well, that is carbon steel, ERW, saw pipes, stainless steel, seamless and welded tubes and pipes. Our utilization levels have improved, but such high revenue growth numbers are also on account of steep rise in the raw material price. Optimization of profitable product mixes, prudent procurement decisions and product pricing discipline coupled with strong cost controls are some of the main reasons behind this excellent operational and financial performance. As you all know, commodities in general, especially metals and that too steel and stainless steel in particular, have been extremely volatile over the few months. And the ongoing Ukraine crisis coupled with COVID restrictions in China obviously have made supply chain and business complex. With strong demand witnessed in India and overseas, we have witnessed good order booking across all segments. So the order booking as on 1st May, the total order book is 2,223 crores. Since its financial year beginning, and there have been lots of changes in terms of geopolitical situations, inflation, rate hikes, tapering of liquidity, volatility, etc., etc. It would be very difficult for us to give the full year guidance. However, we are internally targeting a growth of 15 to 20% at a constant price basis for this year. We have witnessed good momentum in order booking, but with the present inflationary outlook and geopolitical situation, It is to be seen how long the same is continued. However, we believe once the steel prices will stabilize, there will be good traction and we may see good bounce back in the business climate. Something on the capex update, company is undertaking a capacity expansion for stainless steel tubes and pipes for approximately 180 crores. This will be operational in next 18 to 24 months. Further, company is also increasing capacity for carbon steel submerged arc welded pipes and coating at a new location. Capex for same is expected to be around 170 crores over a period of next 18 to 24 months. Both capex put together will have a financial outlay of 350 to 400 crores over the next few years. We can fund the capex through internal sources with some debt component if needed for better capital mix. To conclude, I would just like to say that things are moving more or less as anticipated. Mainly for our recent capex, utilization have increased and mostly stabilized. Products have been overwhelmingly accepted by our customers due to high quality and precision, and numbers have started flowing. We thank all of you for healthy discussions and patience in hearing, and welcome your questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Ashit Modi from Equirus. Please go ahead.
Yeah, hi, Ashutosh here. Firstly, congrats on the good set of numbers for the year and quarter as well.
Modi. So the audio from your line is sounding very soft. Can you come a little more closer to the mic?
Is it better now?
A little better.
Yes.
Please proceed. Thank you.
Yeah. Firstly, congrats on the good set of numbers on annual and quarterly basis as well. Now, this SS capex that you're announcing is basically for which kind of pipe and also carbon steel? I mean, which kind of pipes you're looking at? Because we already had a seamless capacity, so is it different kind of pipe?
So it is stainless steel tubes and pipes. Seamless welded is a mix of all. So it's a capacity expansion of the existing product line.
So, but we added this 20,000 tons capacity that is not fully operation load utilization level. So is it a different kind of tube that we're targeting through this expansion or the same?
No, the 20,000 tons is for extrusion press, which is hot finish. This capacity expansion is for the current capacity what we already have for cold finishing.
Okay, so the cold finishing will go from where to where?
That number update on the capacity from where to where we will get back to.
Okay, and in carbon steel, which segment we are adding? Like you say saw, but is it the helical saw or LSAW?
Yes, it will be helical saw along with coating plant.
And you're looking at location outside Gujarat?
Yes, location will be outside Gujarat.
Okay. And you said 15 to 20% growth you're targeting for next year. Is it revenue growth number or volume growth numbers?
This is the revenue growth number. It can be 20 to 25% also. Okay, because we already have these 970 crore sales in last quarter, so ideally, and second half we did very well, so I think ideally should do better. Yes, but with the correcting raw material prices, I can say 20-25%, but if the raw material prices drop further, so it will have a direct impact on the revenue. Okay, but the EBITDA margin probably in that case will be higher, right? Because remain range bound between 15 to 18. Okay. And last time you had highlighted about whatever we have bid in the carbon steel and stainless steel segments. I think we had last time highlighted 600,000 tons we have bid for, and out of which some 4 lakh tons was oil and gas and water and all. Any update where we are in terms of what we have already bid for in carbon steel and stainless steel segments? last quarter when the update was given, most of the tenders have been finalized, so which have some and the announcement were given to the exchange and must have come to you also. So right now for carbon steel, about 10 lakh tons both in oil and gas as well as water is under bidding.
10 lakh tons. Okay.
Yeah.
And can you highlight which projects, like which are the bigger projects out of these?
There are plenty of projects because state-wise there's Gujarat, Madhya Pradesh, in south also, and then the oil and gas, some of the oil and gas projects in the east also. Last time there were one or two big projects, so I could name it, but the list for 10 lakhs is quite elaboratable.
Okay, so this is a mix of oil and gas and water. Okay.
Yes, about 60% is water, 40% oil and gas.
And the stainless steel side, how are you seeing the momentum in terms of export side? Are you seeing more projects coming up or more, like say we are waiting for more projects in the overseas markets now, in SS segment?
Yes, exports is picking up.
Okay, so SS should see a high growth next year, right? Because the new plant utilization will increase.
Utilization of extrusion press will add to the growth of stainless steel products.
Okay. Okay, thank you. I'll join back with you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Hiren Kumar Desai, an investor. Please go ahead.
Yeah, sir, congratulations on the good result. I would like to know the total capacity currently that exists for stainless steel and carbon steel pipes and current capacity utilization.
So roughly for stainless steel it is 40,000 metric tons.
Okay.
48,000, sorry. 48,000 for stainless steel and 5 lakh tons for carbon steel.
40,000, 48 for stainless steel and
5 lakh for carbon steel.
Yeah, and the current capacity utilization?
Capacity
like
utilization
as of FY22.
For various segments it is between 60 to 80%.
In both segments?
Yeah, in both the segments.
Okay, and any plans for, other than what you mentioned, okay, for the, as of now, the capex plan is 350 crores, as you mentioned, right?
Yeah, 350 to 400 crores.
Okay. And it, while answering the previous participant, you are guiding for 15 to 20% revenue growth. So you are kind of assuming higher volume growth, right? Because of softer steel prices.
Yes.
Okay. Okay.
One is, of course, the higher volume growth in terms of tonnage also, and rupees also.
Yeah. I get that. Okay. Thank you, sir.
Thank you. The next question is on the line of Vikas Singh from Phillip Capital. Please go ahead.
Good afternoon, sir.
Yeah, good afternoon.
Yeah, congratulations on very strong set of numbers. Sir, I just wanted to understand the rationale of new SS capacity expansion, because we have already put up 20,000 KT, which we have not started rolling out any material from it. So not even half of the utilization, and we started something new. As far as I understand that even in our previous communication, we said that it would take couple of more 2 to 3 years for this new capacity to fully utilize. So, and this timeline for your next capacity is 18 months. So just wanted to understand why there is overlapping, or what is the thought process behind it?
No. So this capacity expansion, as I had clarified earlier, is for cold finish. 20,000 tons which we have expanded is hot finish. And in the last call I had mentioned, yes, 2 to 3 years it will take for it to reach at optimum level, the hot finish. But by that time, because for any capacity expansion it will take 2 to 3 years. So by that time we should be ready with another cold finishing line.
Okay. And many of our competitors are also putting a lot of capacity in this space. So just wanted to understand, how do you see the overall industry size moving up so that everybody would be accommodated, or are we going to see some price war going forward?
Definitely everyone is increasing capacity, but at the same time the market is big enough and we have export market also.
And it requires time.
Yeah, so for any new players, the time required will be much more than the existing and established players.
Understood, sir. Sir, can you just give us some market size of SS if you have what kind of current market size is there and what kind of the industry growth we are expecting going forward?
So global stainless steel seamless pipe is close to 5 lakh tons.
Okay.
And it is growing at between 5 to 8 CAGR. So plus
Okay.
more of the manufacturing is based out of China and India.
Understood. So this new capacity could be more from the export perspective in mind. Is that a correct understanding?
Both export and domestic, both.
Understood, sir. Sir, what was the tail end capex which is pending from the past capacity expansion, if you could tell us, and effective FY23 capex plans?
No. So from the past, we had 2 major capacity expansion. Both have come into commercial production. So there is no some balancing equipment here and there during the year. That is a general capex, but nothing is pending from the past.
So not much is pending, and this new capex would be more of a FY24 than FY23. Is that?
In fact, on the product front, it is done, but we have one solar plant which is yet to be operational, 15 megawatts. So that capex is still ongoing.
Okay, sir. Just one last question on our working capital, which has increased substantially, given that we have a very high volume growth target. So is it okay to understand that even though the pricing are coming down, our overall absolute working capital would remain high for this year, or do you think that the second half we get a lot of working capital release?
See, ours is a working capital intensive business, because one thing is ours we work on right now is the made to order scenario where we book our raw material on back to back basis. Second thing is because company has been not leveraged, means debt free. So we are not going even for LC bill discounting to remove the LC creditors debtors from the books because there is a negative carry if you go for discounting. So that results into a higher working capital involvement in the business. It will continue going forward also, because one thing is major part of business top line growth will be coming from existing business model, that is made to order scenario. Some addition of stock and sale products will also be there, particularly from new hot extrusion facility, which will again require initial investment in working capital to build up the required inventory range of all the products. So this year we may see some increase in working capital. Gradually it will settle somewhere in next 2 to 3 years time.
Understood, sir. So what is the net cash position as of?
See, as on date, if we talk about today's date,
So then net cash will be more than 100 crore with the company. As on 31st March, it was neck to neck.
Okay. Okay, sir. Thank you, sir, for answering my question, and all the best for future.
Thank you.
Thank you. The next question is on the line of Abhishek Poddar from HDFC Mutual Fund. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, this margin range you gave was 15 to 18%. And you also mentioned that steel prices, raw material prices would be volatile. So trying to understand that how should we think about margins? If, let's say, the steel prices are lower, then should we assume that the margins would be higher and vice versa? Or should we think about it more like an EBITDA per ton?
See, basically, it is more like EBITDA per ton. But because ours is a made-to-order scenario, it is very difficult to give a standardized figure for EBITDA per ton. That's the reason we talk about EBITDA in percentage terms only. Because we are not right now in any made-to-order scenario.
Understood.
So, in case, theoretically speaking, in case raw material prices come down, our EBITDA in percentage terms should be going up. But it never happens. Prices are lower when demand is lower. So somewhere you need to adjust your margins also. So it continues. In case of higher price scenario, usually, theoretically speaking, shrinkage should be there. That also never happens because then demand is also good. So somewhere it settles here. And this 15 to 18% range is looking to the product mix. Sometimes higher value added products percentage contribution to the top line may be higher. So then we may see 17-18% sort of EBITDA. And if the percentage of lower value added products is higher in top line, then we may move towards 16-15% sort of thing.
Understood, sir. That's very clear. So, given the stainless steel volumes will keep on going up for next 2 to 3 years, should we assume that EBITDA, let's say not this year, but maybe next year, could be towards higher end of the range of 18%?
See, it should be. Our efforts will be in that direction only. A lot will depend on the market and everything, but we will try to see the percentage of higher value added products keep on increasing in the overall product basket.
Understood. So just last question, this 20,000 ton capacity, seamless capacity, how do you see the capacity utilization this year and next year?
This year we are targeting close to 30% utilization.
Okay, and it will be a gradual improvement in next year, or
yes,
it could be a big jump, sir?
No, it would be a gradual utilization increase.
Okay, understood. All the best, sir. Thank you.
Thank you.
Thank you. The next question is on the line of Aman Thadani from Solidarity Investment Managers. Please go ahead.
Thank you for taking my question. Sir, what is the peak revenue that we can get from the current capacities?
Close to 5,000 crores.
Okay, and what would it be from the new capacity that you currently announced?
That numbers are still we are working, but two times the asset turnover ratio.
Okay, thank you. That is it from my side, sir. Thank you.
You can consider roughly 600-700 crores of maximum revenue potential from the new investment.
Okay, okay. Thank you. Thank you.
Thank you. The next question is on the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Hi. Thanks for taking my question. I had 3 questions. So my first question is on, you had mentioned how the SS seamless market is largely dominated by India. I just wanted to confirm that once again because there are a couple of peers who seem to be European based and Japanese based. So wanted to.
There are players from Europe, Japan, Korea, even US, but majority of the capacity is in this area, these 2 countries.
Got it. And would you also be able to share some numbers on the welded SS welded market?
Welded,
in millions of tons.
yeah, welded is a huge market, close to 1 million tons.
More than that.
Yeah.
Yeah, got it. And
Consider the architectural and the infrastructure, it is maybe 2 or 3 million tons.
Got it. And so my next question is on one of your peers who's also in the SS is recently looking to list, and they seem to be doing SS pipes for chemistry, chemicals, and engineering kind of pipes. So is this an area of interest for us?
Can you repeat the question, please?
Sorry, there is this a competitor in the SS space who's looking to list, and they are more into the SS pipes for chemicals, for engineering, more of these small diameter pipes. So just wanted to check whether this is an area of interest for us.
We are already supplying to that industry.
Okay, and how much would that be? Like the chemicals, how much would that be for us today?
No, of the total spectrum, the revenue might be 5 to 8% only for the chemical pharmaceutical industry.
Yeah, 5 to 10%.
Got it. And so my final question is, oil and gas, the domestic refinery space, how much of our order book would be coming from that? And, if one just looks at this piece from a 3 to 5 year time horizon, is this something that you guys are optimistic about from a growth point of view?
This is for carbon steel pipes, correct?
Yes.
Yes. So, majority of our line pipes order is from the oil and gas space. So, within oil and gas, city gas distribution, product pipeline, gas distribution lines, all put together next 3-4 years with the dream of the Prime Minister to connect the whole country with the gas network and pipe supply. So growth for 3 to 5 years, definitely that vision is already there.
Got it. And this holds true for so we're seeing that in oil as well as gas. I meant from a refinery point of view, we are seeing growth over the next 3-4 years. It should be across both oil and gas categories for us.
Yes, both oil and gas. Like HRRL refinery expansion is, and the new refinery is going on. So the crude pipelines for that. Then once the crude pipelines are there, and then the refinery starts, then there will be product lines.
Right.
And then lot of petrochemicals.
Yeah, a lot of petrochemical plants are expected. So there, both mix of stainless steel and carbon steel, both will come.
And demand increasing 8 to 10%.
Got it. Thank you for answering my question. I'll join back in the queue.
Thank you. We'll move on to the next question. That is on the line of Kunal Shah from Carnelian Capital. Please go ahead.
Hi, thank you for the opportunity and congratulations on good set of numbers as well. I had a question on margin. Vimalji did allude to in the previous participant question as well. So two broad questions. One is basically how is the sense you guided for a revenue growth of about 20%, but then that will depend largely on how the metal pricing are moving, right? So if you could help understand what kind of volume growth we are seeing on the ground, because prices went up, have cooled up in the last few days. So are you seeing holding back of capex, right? And if you can help understand how does our pricing mechanism works, because obviously our margins have dropped off in the current year. So volume growth, how should one look at for FY23? And at the same time, how should one look at profitability growth and margins for the coming year?
So, keeping the prices stable in terms of revenue in rupees, I'm saying, there will be a growth of 20 to 25%. Now, if the prices go down, the number can come down or may come down, but the volume in terms of metric ton that growth of 20% will remain.
Okay. Okay. And how should that translate into profitability growth? Because even in the current year, our revenue growth has been fantastic, but our PAT growth, because of the margin compression, has been less than the revenue growth, which is quite obvious as well. As you said, that EBITDA per ton movement is something which we should look at, but considering we are into different segments, it becomes difficult to compare on year-on-year basis, on quarter-on-quarter basis. So how should one look at profitability for FY23?
See, Kunal, this broader range of 15-16% to 18% seems to be maintainable over a longer period also. In current year also, if we talk about some compression in margin, that is mainly because of the higher contribution to the top line coming from the line pipe, which is a low margin business. That line, because in stainless steel and process pipes, one cannot expect to have a very significant jump because they are dependent on certain very niche application requirements only. Whereas in case of line pipe, volume requirements are there. So major growth driver in top line has been line pipe, which will continue. Going forward, contribution from new hot extrusion facility and the newer capex which we are planning, which may result into higher value-added products, that will also be there. Plus, we have to understand one thing: in case of stainless steel, there may not be any significant volume growth, but value addition can be very high depending on the product mix. Because we try to have this thing we should be having rather a better margin product than a product which gives only top line with a lower margin. And it is possible in stainless steel to continuously focus on higher value-added products, and that is the reason, in spite of increased competition, we have been in a position to safeguard our margins to a great extent.
Correct. Correct. So basically, sir, it would be right to understand that the gross margin compression that we have seen from FY21 to FY22, right, is largely on account of basically product mix, and not a case where we have not been able to pass on price increase or something of that sort. Would that understanding be right then?
You can say that majorly you are right, because in our case, all the orders are on fixed price basis. We cover our raw material on back-to-back basis, and that is the reason you must have observed our investment in inventories have moved up significantly compared to last year.
Correct.
Because a lot of inventory was purchased. Okay? Because all orders are on fixed price basis. But in some cases, because of the sudden price increase, there might be some cases where we were not in a position to book the raw material immediately. So some minor impact will be there, might be. But it even out over a longer period, because there will be cases where we get the benefit also. So and that is the reason you can say largely more than 95% of the reason can be attributed to product mix.
Correct, sir. Correct. Thank you, sir. Just one question, sir, on the capex front. So we were, deliberating on putting up a plant probably outside India, right? And now with this capex announcement, I believe one thing is obviously improves our visibility beyond FY24. But is there anything more in the offing as well? Because in the next year, our cash flow generation again would be very robust, at least for the next 2 years. So are we contemplating anything outside India as well? Or probably nothing as of now? This 350 odd crores capex, which we have announced in the 2 segments in India, is fair to assume is what is there on the plate as of now.
Right now, whatever has been finalized, that we have shared with you. Of course, team is working on other growth opportunities also, because to continue the growth, after 2-3 years, we need to have significant volume growth potential. So that can come from number of investment in different products and different opportunities. So at appropriate time, once these are finalized, we will be sharing that info with you. But more capex can be expected as we move forward. Right now, team is working on evaluating various opportunities. These two have been the ones which have been finalized.
Fair enough, sir. Thank you very much, sir, and wishing you all the best.
Yeah.
Thank you.
Thank you. The next question is on the line of Manoj Baheti from Carnelian Capital. Please go ahead.
Good evening, Prakash ji. Good evening, Vimal ji.
Yeah, good evening. Thank you.
Sir, couple of questions. First one is, as you mentioned that our stainless steel capacity is 50,000 and global is around 5 lakh. And if we see our aspiration towards moving towards value-added segment for which we already have capacity, just wanted to understand that what will be our right to win in this value-added segment when we are competing with existing stainless steel player across the world, and how we are going to gain market share in this segment going forward, which will lead to structural improvement in our EBITDA margin once we move towards the value-added segment, a higher proportion of our volumes.
Manoj, I would like to correct you at one place. Our capacities of stainless steel, 48,000 tons, is bifurcated between seamless and welded. Seamless is close to 28,000 tons, and welded is close to 20,000 tons. And this 500,000 tons of capacity which Manojji has discussed, that was about seamless only.
Okay.
So we will be having closer to 5% of the global capacity in seamless with our new hot extrusion facility. Okay, right. One thing. Second thing is right now also in stainless steel, almost 30 to 30% of turnover is coming from physical exports. Plus another roughly 15-20% comes from indirect exports, because the tubes which we supply to equipment manufacturers, then ultimately those equipments are also exported. And we have been competing with global players like Sandvik, Tubacex, Salzgitter, and all others since last several years, and we have been successful in bagging orders from those countries where local industries are well established, like South Korea or Japan, even Japan also. So we are confident with our focus on quality equivalent to what global players are manufacturing, and the prices which we can offer, being very efficient converters, you can say. Our capex cost also continues to remain very, very efficient. Per ton of capex cost will be very, very efficient if you look at the global capex cost for the similar products. So we should be in a position to establish ourselves for newer products also. And focus has been to continuously explore manufacturing import substitute products within the country, and those products which we can manufacture and supply in competition with the other global players in the global market. See, we have been in a position to get approval of Saudi Aramco for our stainless steel existing product lines. So that itself is an achievement which establishes about the quality standards which Ratnamani is in a position to maintain. Ours is the only company which is approved by Nuclear Power Corporation of India in the country. We have been supplying for defense applications also. So we are very confident with this already established credentials and established track record, we should be in a position to find approvals for majority of the newer developments in the product applications also.
Sir, if it is just a 5% of global capacity, and if we have definitely we have a advantage on account of the capex side, capital efficiency, as well as in terms of the cost advantage, as well as the product is at par. So with this 5% kind of capacity, are you hopeful that you will be able to absorb this value-added segment in next 1.5 to 2 years? Because I think a significant portion of the time takes in terms of getting the approval thing behind. So in next 1.5 to 2 years, we can expect that the value-added segment, the capacity which we have put, you will be completely using that towards that, and we will see a structural margin improvement on that.
See, in case of hot extrusion, It is not this getting approval is not the challenge. Getting the production parameters established is a challenge, because each size and each grade will have a different production parameter, because that product needs to be heated to almost 1150-1200 degrees Celsius, and then hot extruded within a given time frame to get the desired output quality. So that setting up that production parameters, it takes time, because all the varieties, all the sizes and all the grades cannot be hot extruded in a very short period, and that is the reason usually hot extrusion takes longer time to achieve the optimum capacity utilization. So in next 2 to 3 years time, we should be in a position to have entire range available with us to this hot extrusion facility, and majority of the approvals already are in place and are in the process. We are in the process of getting approval from the newer customers also.
Got it. And sir, lastly, if you can give us some color on like current macro headwinds, like where means there are multiple headwinds, and means how do you see the scenario panning for you? Means in terms of like extreme fluctuation in commodity prices as well as interest cost going up, will it lead to some kind of deferment of capex or a slowdown of order book for us going forward also? So just wanted to understand like what kind of discussions or order pipeline which you are having with your customers.
With this high also, if you see, our order book is currently at the highest, 2,300 crores. And things have started to come down. So we don't see difficulty in booking the orders. Or there is the demand side at least for another 2 years. Beyond that,
See, basically in case of stainless steel, because the product itself does not form major part of the overall project cost, and it is a must. It is a must requirement for any continuous process industry. The demand will continue. Capacities are also not very large. In case of line pipe, of course, some challenges may start coming up once the required infra in oil and gas is over. But by that time, Jal to Nal project should be starting. So maintaining top line should not be an issue. And if major capexes are drawn up by the government, then margin shrinkage should also not be too high, even if it is water application products, because ultimately everything is demand driven.
Right, sir. Thanks for taking my questions and wish you all the best.
Thank you.
Thank you. The next question is from the line of Madhav Dhanuka from Fintrust Capital. Please go ahead.
Hello. Thank you, sir.
Your line is unmuted. Please go ahead.
Thank you, sir. First of all, congratulations for good growth set of numbers. Sir, mostly my all questions are answered. I have one question. Can you tell me in the more details of current price trend of the metal and outlook on it?
Metal prices before the war a quite correction had come, but once the war started, it had abruptly gone up because of a lot of buying from Europe. But now with the quota getting exhausted, it has again started to go down. So it will remain volatile because of the current situation. But long run, I see prices going down.
And so what's your outlook on quarter one of financial year 23 on the metal price?
Sorry, can you repeat it?
Sir, on the growth outlook of the metal prices of the quarter one of financial year 23.
It's very difficult to predict steel prices, but it will settle down somewhere lower than the today's price.
Okay, sir. That's all from my side. Wishing you all the best.
Thank you. Thank you.
Thank you. The next question is on the line of Akshay Kotari from Envision Capital Services. Please go ahead.
Yeah, thanks for the opportunity. Sir, recently there was a removal of anti-dumping duty from the Chinese. So how are we impacted?
On what product?
So I think there was some notification on 1st Feb. In February month, there was removal of anti-dumping duty on certain steel and stainless steel products. So are we impacted by it or no?
No, not related to us. Yeah.
Okay, not related to us. And of the total 5 lakh tons capacity of stainless steel, how much would be the capacity from China?
No. Of the total market, you mean to say?
Yeah, total market, sorry.
This is excluding China. This is outside of China. China, though, nobody knows.
Figures of China is difficult to know.
Okay, I understand that. And in the export market, which would be the geographies which we are seeing traction? So you did talk about Saudi Aramco, and so where are the
Middle East and Europe?
Okay.
Southeast, Korea, Japan.
Okay. And there was also a notification that CGD companies are seeking for extension with the government for around 2 years. So would we be impacted by these, what we can say, they are not able to set up these pipelines. So how are we impacted regarding that?
No, so they are trying to defer their timelines because of the increased steel prices.
Okay.
But the number of geographical areas awarded are too much. So as it is, if it is distributed for another 2 years, it becomes better for us.
Okay. Thanks a lot. That's it from my side.
Thank you. The next question is from the line of Diksha Upadhyay from Fort Capital. Please go ahead. Diksha, your line is in the talk mode. Please go ahead.
Yeah, good afternoon, sir.
Yes, good afternoon.
Sorry, I joined late. I just want to know revenue breakup for carbon and stainless steel.
The breakup we've decided not to share. Yeah.
Okay.
It's confidential.
And about volume?
Volumes meaning volume. See, the total mix is already given. The total revenue.
Okay. So in terms of volume, like I want to get breakup for carbon and stainless steel.
No, that cannot be shared.
Sorry. See, we regret because from this quarter onwards, we have decided not to share this info because one thing is there that now number of people have either ventured into stainless steel or they are trying to venture into stainless steel, which may hurt us in the longer run because they are used to work at a very lower margin business and on pricing anybody can compete. So in the short term, it may be detrimental to the interest of the company. That is the reason we have shared the total numbers, total volume and total turnover, including both the segments. So I hope you might have got it, and if not, so please share your email ID. My email ID is vimal.katta@ratnamani.com. I'll revert back to you with the quantitative info. Yeah.
So can you repeat your email ID, please?
It is Vimal, VIMAL .katta, KATTA.
Vimal, no? Hello?
L.
Okay, Vimal @
Vimal.katta, KATTA.
Okay.
@ratnamani.
Okay. Thank you, sir.
Yeah. Okay.
Thank you. The next question is from the line of Anurag Patil from Roha Asset Managers. Please go ahead.
Thank you for the opportunity. So just a small query. Can you at least share the total volume number for FY22?
Yes. Total we did close to 254,000 metric tons, both the product, against 231,000 metric tons in last year.
Okay, sir. And how much was the contribution from exports?
The exports will be closer to 500 crores plus. Yeah.
Okay. And sir, there are we facing any logistic challenges there?
Yes, because of the global supply chain which is affected, the time taken earlier and now, and with the congestion also, it has increased.
Okay, sir. That's it from my side. Thank you very much.
Thank you.
Thank you. The next question is on the line of Abhijit Bora from Sher Khan. Please go ahead.
Sir, most of the questions have been answered. Just one clarification, as you have discontinued giving the breakup of volume and revenues. Should we directly take EBITDA per ton, like you have given total volume, we have the EBITDA, to just have a understanding that why the margins are moving up and down rather than taking percentage basis?
No, see, margin depending on the product mix will change quarter on quarter. So it is very difficult, and quantitative information segment wise is hurting us somewhere. So we have decided not to share on the call.
No, sir, I understood that, and just wanted one understanding that if I do a back calculation on the Q4 volume number, I get EBITDA.
It will give a wrong picture because dividing total volume by total tonnage will give a wrong picture, because it depends on the product mix, right? How much, what is the contribution of SS, what is the contribution of carbon steel? Within carbon steel, there are so many products. Within stainless steel, there are a number of products. So the mix keeps on changing. We try to remain in that 16 to 18.
Okay. So would it be fair to say that this quarter the sequential move in the margins were due to like pickup in SS order booking, right? Will that be the right assumption?
Yes. Yeah, that assumption would be correct.
And also there is a benefit of operating leverage also, volumes also, or not?
A little bit, but major would be on depending on the product mix.
Okay. Okay, and sir, what last quarter Q4 FY21, if I see the margins were quite high. So, like, was there any one-off last quarter? Q4 FY21, I'm talking about Q4 FY21.
Again, the revenue distribution in the total revenue among the products would have been more value-added products during that quarter.
And plus within the products also, there are sometimes orders with better margin compared to the normal one. See, in our case, it is very difficult to normalize. So that is the reason we always talk about year-on-year comparison instead of quarter-on-quarter, because quarter-on-quarter will never give you a figure which can be extrapolated.
Even within carbon steel also, for example, water and oil and gas. Now, if maybe metric ton I do more for water, but oil and gas the margins will be more. So one quarter maybe I am doing only water, another quarter is more oil and gas. So then comparing quarter on quarter will make things more difficult.
So that is the reason that I was asking Q4. You mentioned that we had higher share of value-added product mix. We had a margin of almost 23%, but normally you guide between 16 to 18%. So was this because like you had a strong revenue growth of 40%, but there is a margin contraction, though in line with your guidance, but just wanted to understand on that front.
The product, the distribution between division would be higher from stainless steel, and within that, high value added would be more.
Some more quick delivery orders.
See, it is a little complex because again, ours is a made to order scenario, and within that also all the products will not be giving the same margin. The margin range may keep on fluctuating based on application, the material to be used, the testing to be carried out, the number of pieces required in an order, length of the tube, number of factors are there.
Okay. Okay. Thanks a lot, sir.
Thank you.
And congrats.
Yeah, thank you. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and one. The next question is on the line of Hiren Kumar Desai, an investor. Please go ahead.
Yeah, good afternoon again. A couple of quarters back,
sorry to interrupt. The lines of the management have got disconnected. Please stay connected while we reconnect the management. Thank you. Ladies and gentlemen, thank you for patiently holding. We now have the line for the speakers reconnected. Over to you, sir. Hello?
Hello, yes.
Yes, sir. You're reconnected to the call. Mr. Hiren Kumar Desai, may we request you to repeat your questions for the benefit of the management team?
Sure.
Thank you.
Yeah. Sir, 2 or 3 quarters back in the call, you had mentioned that competitive intensity from the Chinese manufacturer was likely to be lower because of removal of export incentive, etc. So just can you give a sense of how is the competitive intensity in the export market?
No, see, competitive intensity for the export market, the Chinese process is more or less pierced product, whereas what we manufacture stainless steel is through the extruded product. So wherever the acceptance of extruded pipes is there we do not face any major competition from China. Where pierced product is required, of course, China for the export market, that competitiveness is required. But various countries have anti-dumping on China. So again, entire Europe there is anti-dumping, US there is anti-dumping on China.
Okay. So do we have an opportunity to significantly increase our?
Yes. With the stainless steel seamless pipes extrusion, we have that opportunity to have more market share.
Okay. Thank you, sir.
Yeah. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and one. The next question is on the line of Sahil Sangvi. Please go ahead.
Yeah. Good afternoon, sir. So I have two to three questions. One, regarding imports of stainless steel pipe in India. There was a lot of Chinese imports happening still. So how is that? What kind of market share are they having?
Yeah. So the domestic industry is working on various fronts. One of them is the quality control order, which Bureau of Indian Standards. So any pipe coming in the country has to follow the Bureau of Indian Standards. Every country you go to Europe, you go to US, they have their own standards and mechanism to protect their local industry. So within India, we are trying that. That is one thing.
No Chinese mill has that.
Right now, none of the Chinese mills they have BIS. So they have to apply for follow certain guidelines, procedures, and maintain that. So second is we are also working on anti-dumping on China.
Because they are just dumped.
So these two mechanism is there to get the protection from the Chinese subsidized product.
Right, sir. But more of my question was that how much market share is the Chinese imports having right now in our domestic market?
Now,
I mean,
It's about 30 to 40,000 tons in a year.
30 to 40,000 tons of stainless steel seamless pipes in a year.
Okay. And what would be the total the market size in India for seamless SS pipes?
1 lakh tons.
Yeah.
1 lakh tons. Okay, got it. My second question was regarding the solar power plant. So this is at what location and any kind of savings that we can expect?
At near Patan. It is for captive only. It is a 15 megawatt. It is for captive consumption only. It is in North Gujarat, near Patan.
Okay. So this will give us some savings in terms of the cost of the power.
Yeah,
Yes.
it saves some power cost, so it is getting us selling it. Yeah.
Okay. And when do you expect this to be commissioned?
By this June end.
Okay. And lastly, how much capex are we expecting in FY23 and for exactly what project? These projects only will start capex in FY23?
Yes, from the second half of FY23.
Okay. So total spend that we target in FY23 would be how much?
100 to 150 crores.
Okay. Thank you, sir.
Yeah. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. As there are no further questions, I now hand the conference over to Mr. Sahil Sanghvi for his closing comments.
Yeah, thank you, Aizen. So just want to thank the entire management of Ratnamani Metals for patiently answering all the questions. And on behalf of Monarch Network, I would also like to thank all the participants. Manoj sir, would you like to give any closing comments?
No, that's it. Thank you. We'll keep you updated.
Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Monarch Network Capital, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.